Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only, and if you're entertained, please like and subscribe. I'd like to tell you about GRNY. It just came out a couple of days ago, and I think both that it is a good idea and that it is a bad idea. So I have mixed feelings about it. But I do know that, well, first of all, I really like their website. It's easy to find things. Like if you go up here, you can find the team and Tom Lee, who is a big, TV personality, and a lot of people really respect him. He's the portfolio manager for this. So if you like him and you respect him, then this might be something that you are more tuned into. But if you are like me and I just don't really care about an individual too much, like I listen to a lot of people, but I'm not like a cult follower of Tom Lee. But this is a growth focused ETF, and the worst part about it is that the expense ratio is kind of high, but this isn't based off of an index. This is based off of their research and what they feel like will give us the best long-term appreciation. So maybe it'll be worth the more expense ratio. So the granny shot, it refers to a basketball free throw style that, like, it's it looks like a granny trying to do it, and it has a higher success ratio than the conventional free throw style. So they're just trying to say, like, it doesn't have to look sexy in order to get your capital appreciation. You can have a mix of things and across different sectors, and it be the safer way to grow money. So I really also like this infographic that they have. They're putting together one ETF that has 7 themes to it. That's how they've picked their stocks. So they're looking for the short term, which is the style tilt, the seasonality, PMI recovery, and then longer themes they've evaluated for, which are energy and cybersecurity, millennials, global labor suppliers, and easing of financial conditions. And I do like that this evaluation has led them, and they pick stocks that hit more than one theme. But this means that they have stocks in here that are not just for technology, and especially because we're being warned there's going to be a lot of volatility, that if we have an ETF that is a good, like, they've made their own index and this is well-rounded without having a lot of cruft in it, that hopefully the price appreciation we get from GRNY, the granny shares, hopefully that means that we'll do relatively better than the overall market. And I was looking at this because, like, Costco is in here, and that one I absolutely know has a dividend. And that is the worst part about this website, is that they don't actually have the distribution schedule listed. However, I read the prospectus. I read parts of the prospectus, and they intend to do a quarterly distribution, and then if there's any capital gains at the end of the year, they'll pay that out as a special distribution. And so they basically have it as an equal weight, all of these holdings, and then they rebalance once a quarter. So you'll see things come in and out as they evaluate things, and are they going to, make the cut. So for me, if I'm doing growth, and this is part of my growth part of the portfolio, I'm going to compare it to, did I get rid of, nope, it's over here. Okay, hold on. To what I do have in my growth section of my portfolio. So right now I'm mostly in SHG for growth, and like it's very heavy in tech stocks. And so I it's fine, but SCHG has like a lot of things in it because it's based off the S&P 500. Same thing with SPMO. It is based off the S&P 500, so there's just so many tickers in there that even if you have a lot of winning things in there, you get, I mean, some of it's cushioning, but some of it's cruft. So, like, bringing the entire portfolio down. And then VGT is obviously very tech centric because it is the Vanguard Growth Technology ETF. So, I'm also curious because half of these tickers for GRNY, these pay a dividend. So will this wind up being a good choice for a dividend growth fund? Because I'm assuming it might, well, let's not assume anything. I will keep an eye out, and if they pay about 1% dividend yield quarterly, like the yearly, it's about 1% of the dividend yield. If they keep growing over time and that stays at 1%, that 1% is going to get bigger and bigger and bigger. And then it's like the argument for if you're into high income ETFs, why are you also in SHD? Well, I'm in SHD because it's paying 3%, but the price of the stock is appreciating. So if I get in now, my cost is less. And so that 3% turns into an equivalent of what JEPI is, except it's much cheaper. So I think don't be into GRNY if it is for a dividend because it is a 0.75 expense ratio. But I am primarily a dividend investor, so I do keep an eye out for that. So anyways, what are my rambling thoughts on GRNY? I like that they've used those themes to pick their stocks. I agree with all the stocks that they do have in there for the most part. I think it might be a good bet in the next year or two to have something that has a mix of sectors, and you could always, on the other hand, have multiple ETFs, but it is easier to manage just like one good ETF versus a bunch of them. But I think this will be an interesting ETF to keep an eye out on because it is Tom Lee is the fund manager for it, and a lot of people do respect Tom Lee. And so I'm wondering if it's really going to take off. And I do like the stocks that are in the $20 range. Like, to me, like, if I just get in at $20 and it appreciates to $100, then good. But I'd rather not, first get into it at $100. So, there's that too. But do you think that this would eventually replace a part of your growth portfolio, or do you think that this is a very short-lived type of thing that's going to happen? Anyways, I will talk to you later. Bye.